David Teese's early comments pointed out, is we're in a time period where things that really worked for a long time are being questioned. So, and especially for corporations who are the important players in our social system and our economy and so forth, this issue of the crisis of legitimacy. What is it that has led to this condition that threatens maybe the engine of economics in our country? And I had lots of prepared remarks for this, but because we're starting late, I'm going to not repeat the entire litany. But the truth of the matter is that it can be captured in the failure of distributive justice. There's something going on across the society that relates to distributive justice, and the economic system somehow is finding itself inability to deal with. And we're focusing on the role of the corporation in not losing its legitimacy, and within that, we're looking at the subject of corporate governance. Because after all, that's the place where we try to either have oversight over the corporation or where we discuss the kinds of issues that the corporation ought to be dealing with. And in this case, we're dealing with these kinds of issues. And there is no one form. In other words, if we look across liberal democracies, Scandinavia has a different institutional structure than the United States or Germany. And so what we thought of doing is that we will have two of our panelists are going to at least share with us the evolution and current application of corporate governance in two different social systems. So we're going to look at Germany, and we're going to look at the UK. And why do we pick those? Partly because of the people who were able to recruit, but partly actually because when you look at the data about the growth of inequality in wealth creation, and I'm not going to bother you with all the details, but I actually commissioned a replication of the study that will appear in our current journal that shows that over the last 10 years, the inequality in wealth creation has actually even picked up in countries like Scandinavian countries. Okay, that is sort of a surprise because we would not have expected it. Okay, on the other hand, the UK is actually pretty well balanced, but maybe for different reasons. But maybe we'll find out more about it. And lastly, the other reason that we need to think about all these things is that, as David pointed out, we have a new player on the block. It's called China. We've been spending for the last 4 years, we've been spending 4 months a year on the ground there. And China is playing by different rules, and I don't think they're going to adopt liberal democracy, any form of liberal democracy, yet they could actually create an economic system that will give the US economy and the liberal democracies a run for the money. In other words, they are likely to be able to do that for completely different reasons, but it does challenge our own system, and so we need to think about the external and the internal. And what we've done is we have 3 panelists with us today. We have Professor Brian Cheffins from Cambridge University. He's a legal scholar and has written a lot about corporate governance and knows corporate governance in the UK extremely well. We have Professor Talaulicar, who is actually also the editor for corporate governance in my journal, and knows German corporate governance and the history of corporate governance in Germany. And we have Sarah, I don't know if I'm supposed to say Cohen Williams.
I always say it's okay.
But the Cohen actually has a special meaning for me because her mother was the best president that Duke University has had for 8 years, so while I was still active at Duke. And but she chairs a foundation that is has been thinking about these kind of issues, especially at the level of corporate governance. Okay? And our plan is like this. Probably have to cheat you a little bit out of the time that we allotted you. We're going to hear, they're limited to a maximum of 15 minutes. And then we would like to open, and I may or may not still give you some thought about corporate governance that I've been studying. And then we would like to open it to a conversation. Don't ask, it's not a Q&A session. It's going around the room and listening to what you picked up or you want to share with us or what issues come to your mind so that we can capture these ideas as we're thinking about how we're going to create I don't know if David Thies wants to do a book or some series of articles, but the point is we want to capture it so that we create a common body of knowledge about how we've been thinking about it and how this might shape discussions about corporate governance. So with that, I would like to ask Brian to get us started.
Okay, thanks. So with the panel, we agreed we were not going to use PowerPoint slides. We talked about distributing an outline, and then I think that idea got dropped. But I brought all these with me, and since I have to catch the train back to Cambridge this afternoon, I'm going to distribute them so you can follow along with what I'm going to say, so I have less to carry. So I hope they're of some assistance. If you just take one, and I'm not sure how it works for the numbers, but we'll see how this goes. And I'll wait for them to work back because there's a couple of quotes from Adam Smith, and that way you can follow them a little more closely. Now, a much cited definition of corporate governance is that it's concerned with the systems by which companies are directed and controlled. Adam Smith, in his 1776 classic, The Wealth of Nations, drew attention to gaps in corporate accountability that could justify emphasis on corporate governance. In analyzing joint stock companies, he said of the balance between shareholders, then often known as the general court, and the board of directors, that the board is frequently, I'm quoting now, subject in many respects to the control of a general court of proprietors, but the greater part of those proprietors seldom pretend to understand anything of the business of the company, and when the spirit of faction happens not to prevail among them, give themselves no trouble about it, but receive contentedly such half-yearly or yearly dividend as the directors think proper to make to them. So this is what would be referred to now as shareholder passivity. Now, this would be unproblematic if directors were always loyal to their shareholders. On this, Smith said, quote, with the directors of such companies, however, being the managers rather of other people's money than of their own, it cannot well be expected that they should watch over it with the same anxious vigilance with which the partners in a private co-partnery frequently watch over their own. Now, this all sounds pretty gloomy. Smith indeed was a joint stock company skeptic, saying, quote, negligence and profusion, therefore, must always prevail more or less in the management of the affairs of such a company. Now, everyone knows Adam Smith was brilliant. However, publicly traded companies would subsequently thrive. And today, for instance, and I am going to talk a reasonable amount about the United States, even though it wasn't advertised that way, partly because I wrote a book on it recently, and I was sort of given a license to talk about it, so you can hear something about the US. But at any rate, in the US right now, approximately 9 out of 10 of America's largest corporations are traded on the stock market. And they are global impact players. As of 2017, 38 of the world's 100 largest companies were American, as were half of the top 10. And the vast majority of those would be publicly traded. Now, how was it that publicly traded companies moved to the forefront despite the gloomy predictions of Adam Smith? Now, one might assume that I've already given you the answer. It was corporate governance. What happened was that corporate governance came into place, mechanisms were in place, and the otherwise irresponsible directors were brought into line. And that would get rid of Smith's managerial negligence and profusion. So that sounds pretty plausible. But if you look at history, no, it does not work that way. And the book I've recently written is a book called The Public Company Transformed, following on the theme this morning that one can come and plug a book, so I'll come and plug a book. And what it does is it discusses changes affecting the American public company from the early 20th century to today. And I will talk, as advertised, about the UK as well, drawing some parallels. Now, the public company has been the dominant form of business enterprise in the US since at least the turn of the 20th century. In contrast, corporate governance is a comparative fledgling. The term was first used with regularity only in the US in the 1970s and did not gain any traction in the rest of the world until the 1990s. And this was not because corporate governance was effective and they simply didn't have a label. If you look at boards of mid-20th century American companies, they were typically dominated, or they had a very substantial proportion of executives on them, and their role was perceived to be advisors to the board, and they would only intervene in the event of a crisis. As for stockholders, retail investors dominated publicly traded firms at that point in terms of share ownership. They were passive. As a 1958 book on shareholder democracy said, they were known for their indifference in everything about the companies they own except dividends and the approximate price of the stock. Now, while corporate governance was an afterthought during the mid-20th century heyday, and what this era was called was the era of managerial capitalism. Executives were in charge. Boards weren't pressuring them. Shareholders weren't pressuring them. Executives were in charge. Now, you might have thought, oh, okay, what's going to happen is they're going to take a freewheeling approach with all the discretion available to them. However, if you look to the 1940s, 50s, and 60s, egregious managerial wrongdoing in the US, very rare. So why was this? Various external factors, if with boards and shareholders being internal, were crucial, functioning as what the noted economist John Kenneth Galbraith referred to as sources of countervailing power. These included unions, substantial regulation at industry level, antitrust laws enforced in a way that discouraged horizontal mergers, and concerns among senior executives that criticism of them could lead to unwelcome regulation. The fact that commercial and investment banks were conservative allocators of capital also curtailed managerial ambition. The external constraints that featured prominently during the mid-20th century eased considerably as the 20th century drew to a close. Unions went into decline, deregulation took hold, and financial liberalization meant that it was much easier for executives to get access to capital. This gearing down of external constraints coincided with the growth of internal constraints in the form of the emergence of corporate governance. This started in the 1970s with considerable emphasis on boards. And the idea was that what should happen is that directors should be independent from the executives. They should be independent from the executives, and they should monitor those executives. And you saw big shifts towards outside directors in American public companies in this era. Shareholders, they came to the party a little bit later. It's well known that institutional shareholders have greater capacity for intervention than their retail shareholder counterparts because of larger ownership stakes and greater resources. And by the early 1990s, they owned as many, if not more, shares than retail investors. But they did get more involved in corporate governance, but it was a pretty halting effort. So you did have more robust corporate governance, but you also had the relaxing of external constraints, and you certainly did not have a perfect match in terms of corporate governance. Hence, you had major corporate governance scandals in the early 2000s. Then you had tightening of corporate governance again. But even then, you still had some wayward banks helping to prompt the financial crisis of 2008. And so you had even further tightening. And indeed, one American law professor referred to U.S. public company executives as of 2010 as embattled. Now I'll switch to the UK. As was the case in the U.S. throughout the 20th century, publicly traded companies were key players in the British corporate economy. Again, mimicking the U.S., from World War II through to the 1970s, scandals were rare in British public companies during this era. As was the case stateside, this was not due to the prominence of corporate governance. The term was rarely used in the UK until the 1990s. And in the mid-20th century, public companies, neither their boards nor their shareholders were a robust check on public company executives. In contrast, external constraints were potent. Unions were powerful. The British government had a penchant for intervening in the economy, and close oversight of banks and a conservative investment bank culture further curbed managerial ambition. External constraints, as was the case in the US, went into retreat in the UK as the 20th century drew to a close. Deregulation and the taming of unions were hallmark features of Margaret Thatcher's conservative government. Big Bang and related financial sector reforms meant public companies could access capital markets much more readily. A series of corporate scandals with these developments could have been anticipated and indeed occurred as the 1990s began. It was at this point that corporate governance, and I should say Britain is a corporate governance leader, but it was only at this point that it really became meaningful in the UK. And that took the form of the 1992 Cadbury Report, which for those who follow corporate governance is a talismanic document. And what happened at this point was considerably greater emphasis on independence of boards. Shareholder activism was also promoted, and this was partly prompted by the fact of the threat of government regulation if institutional investors did not step forward. Throughout the remainder of the 1990s and for most of the 2000s, dramatic increases in executive pay were controversial here. But aside from that, corporate governance scandals, there were no Enrons here, no WorldComs here. So it all seemed to be ticking along okay. Then the financial crisis hit. And then what happened was the corporate governance was blamed, and extensive regulation of banks followed. At that point in time, I think it's fair to say that serious doubts were arising in some quarters about the legitimacy of corporate enterprise. Such doubts no doubt continue in the UK, but politicians here have worked hard to transfer misgivings about corporations into political gains. This has meant that corporations in Britain probably do not face an existential crisis. However, regulation could have a dramatic impact on how they function. In the UK, efforts by politicians to capitalize on dissatisfaction with business ironically have been led by the ostensibly pro-business Conservatives. Under Theresa May, the party sought to appeal to voters with a litany of governance proposals with a pro-stakeholder orientation resembling arrangements prevailing in continental Europe. Ironic, given Brexit. The Labour Party has subsequently proposed renationalising utilities and the railways, is keen on mandating employee representatives on boards, and wants to force companies to hand over 10% of their shares to the employees. And finally, there's Boris Johnson, who's used a well-known four-letter word beginning with F and ending with K to describe what he thinks of business. So this is the kind of environment that politicians have tried to take over whatever misgivings and dissatisfactions exist with business. Now, given the foregoing trends, it's hardly surprising that the number of public companies in the UK has fallen from 1,200 in 2006 to 950 as of this year. There's also been a marked decline of the number of public companies in the US. Now that's prompted speculation on both sides of the Atlantic about the demise of the public company. Now I think the public company in Britain, I think it is in trouble. I think British business is in trouble. So what I'm going to say is I'm not going to go down that line because I need to develop thinking further about that. But what I would say is I do not see the demise of the public company in the United States. That is not going to happen. What is going to happen is you have a drop in the number of public companies. But if a company is successful for long enough, it will end up in the public realm one way or the other. One way is it will go public. The other way is it will be bought. Who will it be bought by? A public company. Those assets will end up in the public domain. Consider this data point, which people do not talk about when they talk about the demise of the public company. A way of measuring the size of the stock market, the importance of the public company, is stock market capitalization ratio to GDP. It has never, ever been higher in the United States. So dying, well, that's a pretty good form of dying. Now, talk about the future that brings us up to this point. I'll just make a couple of points to wrap up about future prospects for corporate governance. What one would be in relation to the board of directors. So the board of directors, 1970s, considerable emphasis on independent directors and accountability. In the US, it's not clear how much further they can really go. 85% of directors of US public companies are independent directors. Pretty much every company in the US, public company in the US has an audit committee, a compensation committee, and a nomination committee inhabited entirely by independent directors. Where will the move be? I think it's safe to say the move will be with respect to promoting diversity in the boardroom. That's the case in the UK too. Shareholder activism. So the big topic right now, if it was 10 years ago, we talked about hedge funds, but actually the big topic in the US right now is the popularity of passive index tracking funds. And here I'm talking about the big three, primarily BlackRock, Vanguard, and State Street dominating. Concerns exist that their collective common ownership is substantial enough to create very meaningful anti-competitive effects within the American economy. The logic of it is, I believe, that what they are doing is putting pressure on public company executives to dial back their competitive instincts so as to ensure that those firms generate quasi-monopoly profits at firm level. And so that's what would happen. Competition will go down. Problem with this is intervening, influencing, is not what these outfits are about. They are passive index tracking funds. They make their money by being cheap. They make their money by doing nothing other than mimicking the stock market. It is antithetical to them to intervene. I mean, there's a lot of rhetoric that is trotted out, particularly by Larry Fink, but what they actually do, if they intervene, they make themselves costly, and everyone will simply migrate to the cheaper fund that does not engage in activism. Final point I'll talk about in terms of potential direction, shareholder value. So this was brought up in the talk this morning, where it was characterized as a product of Milton Friedman. No, it was not. It was a product of the takeover wave. Milton Friedman was thought of as a kook in 1970 for what he said about shareholder value. So what happened was, takeovers came in, they went, institutional investors they wanted accountable public company executives, and they emphasized, well, we need to just keep an eye on shareholder value. And shareholder value, indeed, by the late 1990s, had moved to the forefront, both in the US and UK, as a way of thinking about public companies. Now, chief executives continue to watch share prices like hawks. However, the notion of shareholder value as a top priority, that's been questioned. So I've already flagged up, there were pro-stakeholder proposals by Theresa May's government. Labour's doing the same. And what you have is that always pushing back is as long as the shareholders choose the directors, both like in the UK and the US, the stakeholder proposals will run up against this. However, crucial to note with respect to these is that what we've been talking about with some of these proposals is changing who selects the directors and giving, for instance, employees greater influence. And so what you've seen, I've already mentioned that the Labour Party has proposed that there be employee representatives on boards. And similar ideas have been trailed by Democratic presidential contenders. Elizabeth Warren proposed legislation last year which would require corporations to allow their workers to elect 40% of the membership of the board. In terms of ensuring that there are shares that are given to employees, Bernie Sanders has proposed that in the United States. Now, it strikes me that it's more likely that these ideas will gain traction in Britain than they will in the US, but the fact of the matter is that the orientation around shareholders, which has been talismanic for the past 20 or 30 years, that there's going to have to be room to move. And to tie it back in with Arie's point, maybe this is all consistent with concerns about distributive justice. Maybe what, as I said, politicians, what they are doing is responding to concerns. These are not coming out of nowhere, and maybe this is the way in which we'll translate through. And with that, I will hand it over to Tim.
Amazing. You must have practiced it to be under 15 minutes.
You know, I have something to think about the train.
Okay, thank you very much. Good morning, everyone. Other People's Money, Corporate Governance and the Future of Capitalism is the title of this panel. And I'm very happy to have the opportunity and the privilege to provide some necessarily selective thoughts on this subject from the perspective of Germany. Germany, a country whose corporate governance differs widely from the one in the US or in the UK, with which Brian Cheffins did just deal. Corporate governance refers to the system, how companies are directed and controlled, how corporate assets are managed and overseen, and eventually how corporate decisions are made or at least influenced. Corporate governance is hence understood as the legal and factual regulatory framework for the management and supervision of an enterprise. Three peculiarities of the German system of corporate governance include first the two-tier board structure that separates the roles of running the company by the management board and advising and overseeing this management by the supervisory board. Second, the collegial structure of the management board, whose members are jointly accountable for managing the enterprise and whose chairperson is just primus inter pares and hence not allowed to issue directives to the remaining members of the management board. As well as third, the co-determination of the supervisory board, in which up to 50% of the members are representatives of the workforce. In addition to these structural peculiarities, the German system of capitalism, the so-called social market economy, emphasizes the social responsibility of market participants, including enterprises. As a consequence, the interests of shareholders are doubtlessly important, but they are not the only interests that are to be considered when corporate courses of action are to be determined and major strategic decisions are to be made. The superordinate maxim is the best interest of the enterprise, admittedly a slightly fuzzy construct, according to which the interests of all relevant stakeholders have to be taken into account, that include, of course, the shareholders, but also, among others, the employees, suppliers, customers of the enterprise, in order to ensure the continued existence of the firm and its sustainable value creation. As also emphasized in the German Corporate Governance Code, the principles of the social market economy do not only require compliance with the law, but also ethically sound and responsible behavior. While some may depreciate the related concept of a reputable business person as outdated and obsolete, I will in contrast argue that ethics and responsible behavior are at the core to renew or to sustain the legitimacy and consequently the functioning of capitalism. Remarkably, awareness of and attention to issues of corporate governance have increased tremendously within the last 2 to 3 decades. In the wake of this increased awareness, numerous governance rules and regulations have been enacted, and companies are compelled to deal much more in depth with their governance arrangements and disclose their implemented structures and processes, as well as the reasons of why these were chosen. Yet, despite all these efforts to strengthen the system of corporate governance further, we also witness a number of corporate wrongdoing and even scandals, a number that is certainly not minor. While the majority of firms may be sufficiently well governed and well intended in their actions, each of these counterexamples of downsides and failures threatens the reputation of and the trust in the current business system. Ladies and gentlemen, let me turn to the subject of executive compensation, an issue that is certainly just one element of corporate governance, but an element that has received particularly much attention in the general public and appears to have at least the potential to decouple the perceived functioning of the business sector from other segments of society. In line with the social market economy and a rather consensus-driven business culture, top executive pay levels were traditionally rather modest in Germany. In the wake of the globalization of capital markets, the entry of foreign investors and a more international ownership structure, top executive pay levels rose rapidly and decoupled more and more from average pay levels. Although the supervisory board determines the compensation of the management board, co-determination of this supervisory board was apparently not effective in constraining top management team increases, in contrast, by the way, to current expectations in some other countries. Due to the public interest, politicians repeatedly dealt with the subject and enacted various types and rounds of regulation, leading to compensation disclosures on an individual base, mandatory compensation reports that grow in length and complexity, advisory resolutions by the general meeting of shareholders on the approval of the remuneration system, and references to a so-called customary level of compensation. Strictly speaking, it appears to be premature to assess reliably the effectiveness of many, if not most, of these rules and regulations. However, it appears reasonable to assert that the subject continues to be in the limelight. Increased levels of inequality have become a major source of concern in many developed countries, including Germany. The academic debate whether variously defined forms of inequality may be good or bad is just one side of the coin. We must not ignore, though, that perceptions and even feelings within society may have the potential to weaken the social coherence that is essential to the acceptance and the functioning of our incumbent economic systems. Some of the assumptions underlying executive compensation arrangements may be arguable, for instance, with regard to the importance and impact of top executives, the existence and effectiveness of global war for top management talents, as well as the suggested motivation effects due to incentive alignments of the interests of executives and their enterprise. Instead of delving into these assumptions and their substantiation, let me conclude by providing some pieces that may be promising to consider in order to move forward. In this regard, the focus, at least in Germany, as I said, is on the long-term interest of the enterprise. We will hear more about the focus on long-term interests just by our next panelist, Sarah Williamson. Communicating and explaining related top management compensation systems will benefit from their clear and comprehensible designs. Compensation systems have frequently become much too complex, partly without doubt also for well-intended reasons. However, a simplification of top executive pay structures basically based on long-term equity and debt may be superior to overly complex and less transparent systems. Essentially, it is the title of our panel, Other People's Money, that is spent for the compensation of hired top executives. There is a difference between hired or appointed executives on the one hand and entrepreneurs on the other that is to be reflected in the design of compensation arrangements. Learning from entrepreneurs could also suggest to support intrinsic rather than extrinsic motivation, as most entrepreneurs are driven by some inner purpose and mission. Striving for the highest possible, solely financial return is not necessarily the most successful strategy, neither for individuals nor for companies. A business culture of accountability, duty and fairness therefore needs to be developed, or if you want, at least further strengthened from my perspective. The aforementioned concept of the reputable business person could provide some guidance in this truly challenging process. It appears to be time to join this conversation and to deal with these challenges. Thank you very much for your kind attention.
Fantastic.
Thank you. All right, I'll step around here.
The panel is determined to give you more time for conversation.
Well, we like to have conversations, so we want to make sure we do that. So I'm Sarah Williamson. I am the CEO of Focusing Capital on the Long Term. Just quick background on who we are and what we're up to. We are a consortium, we are a nonprofit, a U.S. charitable organization, 501c3, that is backed by very large asset owners, so sovereign wealth funds, pension plans, and similar asset managers, big institutional investors and others, and corporations. And with full disclosure, while I am a faculty brat, I'm not an academic, and I have grown up as an institutional investor, and I am a public board director. So feel free to throw tomatoes or ask questions in that vein. So what I really wanted to talk about today, building on what my colleagues have said and building on this topic that we introduced, which is, of course, the Adam Smith quote about anxious vigilance of other people's money, is how do we think about corporate governance dealing with what I think of as the three conundrums of this world. The first is the private versus public. So even in his quote that Brian read most of, Adam Smith talks about the difference between public companies and what he called private co-partneries, which essentially we can shorten to private. So there's a public-private sort of conundrum that is very important in the corporate governance world. There is also this stakeholder shareholder mindset that hasn't gotten increasing discussion, obviously, over the last number of years. And then there is this short-term, long-term conundrum. And so what I'd like to do is just briefly talk about each one of those three and the impact that they have on the way we think about corporate governance. So if we start on the private-public, one thing that I would like to remind people is that while it may have been very different in Adam Smith's day, today there are not fundamental differences between private companies and public companies, except in the area of who their shareholders are. So there are very, very large private companies today that compete head-to-head with many of the public companies we all know. They employ the same employees, they sell to the same customers, they use the same supply chains, they pollute the same air. And so the idea that has, I think, come up a lot recently is that corporate governance somehow should solve the problems that, in my opinion, is really the government's job, which is things like the environmental issues that we have. I think it's extremely important for us to remember that if you're a fish swimming in a stream and the stream is being polluted, you really don't care who the shareholders of the company that is polluting your stream are. And so while I think corporates can play a very important role in this debate, it doesn't make sense for securities laws to take over for other sorts of laws. We have to have those as well. And perhaps that's just in my country where it seems to be, the US where it seems to be, people are backing off on those so others are leaning in. But let's not forget that that is extremely important to protect those things, regardless of what kind of company it is. So on the public-private side, I think the difference in corporate governance, but the fundamental difference in corporate governance between the two, is that in a private company, the owners sit on the board. If a company is owned by a family, or if a company is owned by a private equity firm, the owners of the company are sitting on the board in the room with the management team making those decisions, and typically have a huge influence on the decisions that are made. In a typical public company board, the major owners are not on the board. So I was for many years at a trillion-dollar asset manager. We would never put somebody on the board because if you do, then of course you may get inside information. There are all sorts of legal reasons you don't want to do that. So coming back to whether they're passive or active, typically the biggest owners are not on the board in a public company, and I think that causes a lot of issues. I think the second thing we need to remember is that retail investors, either directly or through their participation in defined contribution plans, which tend to be the biggest, the most growing part of the pension market, typically cannot access private companies. Typically, in most countries, to be invested in a private company, you either need to be an institution or you need to be wealthy. So while some of us decry the problems in public markets, and I agree with what Brian said about the share of GDP and so on, the situation that we're trying to avoid is that there is not a level playing field and that all of the interesting ideas and the wealth creation somehow gets out of the public markets into the private markets. It then accrues simply to the wealthy. Your average person does not participate, and then to come back to Arie's point, we have even more of a problem of distributive justice here. So public versus private, my own opinion is public markets and having well-functioning public markets are extremely important to private markets, to society more broadly. I think the second question that comes up a lot is the stakeholder versus shareholder. And I actually think it's a false juxtaposition between the two. because I think that the goal of almost any company is to execute a long-term strategy in a multi-stakeholder context for the benefit of their shareholders. So I don't know of companies that are successful over time if they don't pay attention to their customers or if they don't pay attention to their employees. Those companies tend to have all sorts of problems and go out of business. So I think that if we think about in the very short term, the stakeholder shareholder could be a direct trade-off. Should we give all the employees a raise and lower our earnings today? Yeah, sure, that's an immediate trade-off. But if we think over longer periods of time, I think sometimes the stakeholder shareholder trade-off has gotten us into a little bit of trouble. And although I sort of hate to do this in this group, I went back actually this morning after we were talking and looked up Milton Friedman's quote about about even companies to saying so Milton Friedman, as we all know in the famous New York Times article, the business of business is business, etc. But Milton Friedman made the point that it may well be in the long-term interest of a corporation that is a major employer in a small community to devote resources to providing amenities to that community or to improve the government. This may make it easier to attract desirable employees, it may reduce the wage bill, or lessen losses from pilferage and sabotage. So even Milton Friedman recognized that if you were a company in a small town, it was in the company's interest to benefit that small town. And so what I would ask you all today is, who's Unilever's town? Or any big global firm. Unilever, for example, operates in, 180 countries. They don't have a company town anymore. So what I would argue is that the stakeholders of a global firm like Unilever are their company town. And so we need to think about that differently, and it's not this trade-off if we have a long enough time frame. And then what I will come back to is this time frame, so the short-term, long-term. It is very true that there are short-term pressures on companies that lead to them not maximizing either their benefit for their employees or their shareholders or the communities that they operate in. And working to offset those short-term pressures is both in the company's and the investor's best interest and is also in society's interest at large. So the things that we're doing from a very practical point of view, particularly around the corporate governance space, to think about these issues are, how does one set up a thriving public company that succeeds over the long term in executing their strategy in this multi-stakeholder context? And in particular, we've done a lot of research on this, and the 3 or 4 things that come out time and time again. The first is ownership of stock, and that having corporate governance board members who own the stock of a company closes what Adam Smith referred to as, it increases the anxious vigilance that Adam Smith referred to. It closes that gap. That may mean less independence. That is less popular in some countries than others, but it's very clear that closing that gap is a way to address this question. The second thing that comes up very clearly in the numbers is diversity on boards. And I was interested this morning listening to John Kay talk about different skills coming to a team. This is a well-known concept, but it comes out in the numbers as well. The best long-term companies have more diversity on their boards. So that is something that is, and the easiest thing to measure is gender diversity, but there are lots of other ways of doing it. A third solution is having explicit language in the corporate governance documents about what the board's responsibility is. So if you look at Amazon, for example, in their corporate governance documents, which are public, the board has outlined that they believe their responsibility is to what they call the long-term share owner. So if you have somebody buy the stock, and let's say Amazon does something that hurts the stock in the short run, and then that person tries to come after the company, they have laid out that that's not their job. They don't see that as their job. And if you want a board where that's their job, you go buy a different stock. And so laying that out up front is not in a time when an activist has come in, is extremely straightforward and is very easy to do, and is clearly consistent with both US and UK law. I don't know about Germans, but I do know about those two. So what I would say is that and then the last thing I will say about the boards is the other thing that they can do well to emphasize this long-term mindset is speak directly to shareholders. So again, this is allowed in some countries and not others. There are all sorts of complications. But having board members who probably by definition are not the biggest owners, at least talk to those biggest long-term owners, makes a big difference in terms of both understanding what their shareholders want, getting that feedback, and also delivering their own message. So as we think about what the goals are here of corporate governance, again, it's to help public companies thrive over the long term, to benefit their investors who are savers, who are saving for long-term goals typically, to benefit their communities, and that includes all of us in terms of innovation and in terms of new products, and their employees, and to have them execute that long-term strategy in a multi-stakeholder context is the goal. And so we think that very strong corporate governance is a fundamental part of thinking about that long-term shareholder value. Thank you.
Thank you. Well, in view of what we have been talking about, I think I will take a few minutes to highlight a couple other issues. They relate to the point about compensation, but also about the point of view that firms manage for the long run, for the long term. My ideas originate with a famous economist who got the Nobel Prize in economics. His name is Oliver Williamson. But it goes back to his dissertation at Carnegie Tech, which had nothing to do with transaction cost economics. Oliver had a very interesting theory. He basically said that managers are motivated to maximize personal wealth while they are employed in a particular company. And in order to do that, they will maximize control over what he called discretionary resources, which in my language would mean organization slack. And the way this works is that they negotiate, they bargain as hard as they can, that their reward at the end of each year is actually tied to short-term goals rather than to long-term goals. They're maximizing their ability to achieve whatever crazy goal it is, 15% increase in sales or whatever it is, but mainly they can control the ability to achieve the profitability goals. Because if they build slack resources into the annual budget, things don't develop as planned, they can save these items which go down to the bottom line and still make their profit goals. How do I know all of this? Well, you won't believe this, but when I was an assistant professor at NYU, I came from Carnegie Tech, and there was nobody in the management department that I could talk to. They thought that I was, from the moon or something, because they were teaching principles of management. The chairman of the accounting department came to me and said, Arie, would you like to do a joint project with me? And basically, we studied companies that supposedly had the reputation of having very tight financial controls. And because of his connections, we went into these 12 different companies, and we observed over the year how they were during the planning period, and then we observed over the year what happened to the budgets, and when did they hire people, when did they do things. And some of the surprising things to me were, and then I'm an assistant professor, we were in one company, and the controller took us to the production business, to the factories, and the manager of the factory came to the controller and said to him, the controller goes to the manager and he says to him, it's okay, you can now introduce this production improvement things that was sitting on the shelf, meaning that when they introduced this, efficiency of production went up, and that in the language of accounting had a favorable manufacturing variance. But to me the question was, how many years was it sitting on the board there before they introduced it, right? Okay, so think about forward. So now, if in fact short-termism, as in fact Demise also pointed out, has become a very important dynamic in the management of companies, then they're not thinking long term. And now we've given them a lot of new tools, which we call financial engineering tools. And this takes me back to a very nice analysis was done of Jack Welch when he was a CEO of GE. In his very first speech to GE people, he said, the internal rate of change of GE does not match the external rate of its environment. And so use that as a way of how to speed things up and how to drop businesses that cannot match the rate of change of the environment. For 16 years, it was great. And then he began to change colors and he started doing financial engineering. Okay? He bought insurance companies and used Warren Buffett techniques and so forth. But to me, the telling point was when he talked to the three candidates who were selected to be the candidates to succeed him. He had a meeting with each one of them, and he told them, by the time you become my successor, we will have stopped borrowing from the future. We will have stopped borrowing from the future. In other words, there's a lot of room to do financial engineering, especially if you're talking about insurance companies and financial companies, to basically create profits. But, unfortunately for Jeff Immelt, it fell on his watch to undo GE Capital because they borrowed from the future so much. So my observation is that we actually are we're assuming that managers manage for the long term, but in my opinion is, the evidence is that they're focusing much more on the short term. And where does the criticism come from? When we begin to allow companies to buy back their stock, and that counts toward the bonus at the end of the year, it's not because they are managing the business, it's not because they're investing in the business. The criticism is that it's like self-dealing. I don't want to use the term, but among us I can say that. And so there's something that got corrupted in this process of the way we reward top executives. And if you add to it the idea of talent that we heard about today, we don't mind that somebody who's really talented is going to get above normal recognition and wealth. But we do mind if some executive, who's just an average executive of Fortune 1000 companies, can benefit above normal returns because the buybacks of stock, for example. Okay? So one of the failures in corporate governance is that we don't make a distinction about the increasing the value of the share because of what you've done to invest in the company and innovate and so forth over financial engineering. Okay? And this is an issue that at the beginning is one of the issues is in this issue of distributive justice, the criticism of corporation. But the mechanism, if you actually look inside, the mechanism is very legal. The board does not know how much to set the salary. So we have very good consulting companies, and they go around and they find comparable companies of equal size and et cetera. And my university just went through this in giving the salary of the previous president. And they found in the 10 universities that we compare ourselves to, and they got all the stuff, and then they justified that they actually gave our president the lowest of the 10 universities that they compared to. But the point is, there is a comparison process. And companies use the comparison process to justify the decision that reinforces short-term decision on the corporation. In my opinion, corporate governance, this is one of the things that really we have to think about, how this can be corrected. It's not that simple, in my opinion, because we don't know how to measure for the long term. I mean, one of the biggest critics of corporations is Clay Christensen at Harvard. He's over and over and over again has made the criticism that companies are managing for the short term, therefore we don't see major innovation. And I can give you the underlying theories why it's easier to do incremental innovation, incremental efficiencies, than to think about the long term or long kind of thing like this. So his observations dovetail with the short-termism. So short-termism is maybe one of the consequences of the current corporate governance structure that, at least when I look at it, I would say we should be talking about. I don't know the solution, but I think it is really a conversation that we should. I will stop here, and I'd like to do the following. I see your hands already up, that's great. Remember, it's not questions, it's observations. We're not doing Q&A. So the person way in the back, you had your hand up first.
Yeah, I'm Bill Lazonic. There's
Yes, John, I didn't
a
recognize.
couple, and we have a session after this. So,
Yeah, right.
but a couple things that Brian Cheffins said I disagree with, which have to do with the, one is the passive shareholder. And well, the first one actually was the rise of shareholder value. I think it was different in the UK than the US. In the US, it was not because of takeovers and then institutional investors were worried about this. It was because of neoclassical economics, particularly Chicago School of Economics. So the Friedman article, it's kooky, I'm going to talk about that this afternoon a little bit. But basically, that ideology ended up dominating. And I was at Harvard Business School in 1985 when Michael Jensen got hired there. No one was talking about shareholder value there before. Everybody was talking about it after. Now, the world was changing, but Chicago, and work that I've done on stock buybacks, transformation of the SEC under Ronald Reagan, was totally captured by Chicago School. The other side of it is that East Coast liberals, the Sanderson types, people now like Krugman and Stiglitz even don't challenge that. The reason is basically that there is a view of capital formation that comes out of neoclassical economics that the money goes through the financial markets and ends up in productive investment. That's not the foundation of capital investment. It's retained earnings of companies, and that's why Arie mentioned stock buybacks are so problematic because you're looting those companies. The second point you made about that hedge fund activism is not important. It is very important in the United States. So take a company like GE. GE is being torn apart by client partners, Int'l, who's never had more than 0.8 of 1% of the shares. Now it's already a company that was highly financialized under Welch and Emeritus, but there's a huge amount of innovation in there. By the way, John Kay's notion that GE was just a manufacturing company, he started GE Labs in 1903. And it's one of the preeminent technology companies in the world. Okay, now that company's been torn apart, and the reason is, it's been able to be because the passive shareholders have to vote their shares. And this is something sanctioned by the SEC in 2003. Once they did that, ISS and then Glass Lewis is the other proxy advisory service, totally unregulated, had a huge amount of power, telling passive investors, oh, here's how you should vote the shares. The only thing that really matters is the board of directors. And if you can lobby ISS, Glass Lewis, and get a few of the big pension funds, particularly the public pension funds, which seems not to care about what happens to the industrial company. You can have a tiny fraction of the shares and control the board and change the whole direction of the company. It's, by the way, just last thing I'll say, it's the only way you can explain, I've done a lot of work on Apple, why Apple has spent $270 billion buying back its shares since 2013. That is afraid of shareholder activists, and it will not say anything about it. And you can see them tearing companies like, well, just Trian Partners, Procter & Gamble, GE, DuPont. Those are game changers. And so that's going on, and it's actually going on all over the world through some people like Paul Singer, ThyssenKrupp in Germany. He attacked Samsung in Korea. In Japan is going on. So this is a big phenomenon coming out of the United States.
Can I at least respond?
No, don't want to. We need to hear other people.
Okay,
Please.
that's fine.
Thank you. I'm Karsten Kowalczyk at the Fletcher School of Law and Diplomacy at Cheffins. And I want to just pick up on your remark, Arie, at the very end, where you talked about compensation and how you can think of short-termism and what is the compensation rule. And what I think a lot of conversations where there's a lot of discussion about executive compensation. But what about if you go into an arbitrary level of the corporation? Not the executive suite, but some arbitrary level, and you ask, what is the compensation rule or the division rule at that level? Now, just as a sort of knee-jerk, if you're looking at, and this may not be fair to all corporations here, but including universities, if you look at some institutions in the U.S., the answer is, well, what do you command in the market? you talk to your boss, and the boss will say, well, you know, go out and find another job and come back and tell me what they're going to offer you, and perhaps we'll talk. We now have a lot of evidence that labor is not that mobile. Not even academic types, business types with sophisticated training are not that mobile. There's recently in American Economic Review a study that shows, for example, that folks, successful academics, at the age where their children are in middle school, high school, are not as mobile as they would be otherwise. And you know, the reason is obvious, right? So because you know, you're tied for a lot of reasons to a community and so forth. My comment is, if the market's no longer helping us set the wage rate at an arbitrary level in the organization, then we need to think about a different rule of splitting the surplus, i.e. bargaining, negotiations. And perhaps Till can give us a suggestion from the European model where, you know, is there a notion of fairness? You sit down with the boss, how do you split the surplus? Thank you.
Let me get a few, yes.
Thanks, Arie. I'm Richard Rumel,
Yes, I did recognize you.
retired from UCLA, but still a consultant to a lot of different firms on strategy. And I don't know the economic theory as well as you guys, but I have seen the insights of these companies. I've seen it at the board level and at the CEO level. What causes the short-term thing? The short-term thing is ubiquitous. It's destructive and it's a catastrophe. At Int'l, we have a nice diverse board. We have people who do not understand semiconductors, and they're drawn from all walks of life and all genders and all colors. But the only language they have in common is accounting. So that's what they talk about. They can't talk about the technology or the competition or the industry because they don't know about it. They come from different industries. They come from different backgrounds. It's nice. It's an independent board. So they talk about accounting. That's the only thing they can talk about. The CEO gets on the phone every 2 months with analysts. And the analysts are my MBA students armed with Excel who have a stupid little model of the growth of earnings. They don't have any uncertainty in the model. It's no stochastics. It's just a simple growth of earnings and an NPV, and that's what the share's worth. And if it's a little dip now, they extrapolate that forward and say, oh my God, you know, your stock is now worth this and not worth it. We've trained them in finance, but they're still idiots. They're terrible at it. They feed that back to the CEO. He's, oh my God, you know, if our earnings go down by this much. Well, he's pretty smart. He knows how to shift money around to try to smooth it. I'm working with a company in Zurich right now. Very frustrating. These are East German engineers that are owned by a U.S. company. And last year they took a hit in earnings because the automobile industry took a dip. And the American corporate headquarters in the U.S., I won't say where, cut their R&D staff in half. Oh, that kind of thing can't happen in a rational world. It happens every day in every company I deal with. How do you stop it? Okay, you stop it by getting rid of these independent boards. You stop it by getting rid of Excel, outlawing it. You get rid of the option payments to CEOs, outlaw stock options. You can't have them. You can't have buybacks in higher than dividends. Dividends are not allowed to be paid higher than earnings. It's a law. Well, why are buybacks allowed to be done higher than earnings? Oh, well, I don't know. Why not? There's a bunch of things you can do here. If I was king, I would do them. But it doesn't take a new theory. It doesn't take us noodling our heads for the next 10 years to figure this stuff out. We know how to fix this. We just don't have the political will.
I agree with what you said, but let me just make another comment. You talk about executives in a company managing for their benefit. This is also true of workers. And you can find, if you look at the history of the former Yugoslavia, which was a workers-controlled economy, you'll find that its fundamental downfall, this has been well documented, was an inadequate level of investment. Because if you're an employee, as opposed to a stock owner, an investment that pays off in 10 years when you're 55 years old is useless to you, because you don't get any money from it. If you had a share, you could in effect capture a net present value sense as measured by Excel, all jokes aside, you would get the benefit of making a long-term decision. If you are a worker who shares in the profits as long as you're an employee, however that share is defined, you don't do it, and the whole economic history of Yugoslavia is really a testimony to this. And again, sticking workers in is not some solution. If you think of the US automobile industry, a different way of looking at it is you had a cartel of 4 players, 3 car companies in the UAW. And the car companies produced bad products at high prices until foreign competition emerged. The job of the UAW was to make sure that the costs were equal across all of these players. They all split the profits. And you could see the implications that there was rent extracted. That wonderful book about Janesville and all of this. When you no longer work for one of the cartel members, your pay drops by 50%. Yeah? That shows you what the market price of labor is as opposed to the cartel profit splitting. So all this rubbish about, you know, putting the workers in and they all sharing the benefits, this to me it's your executives, they're just a different group. And if you look at this wonderful example of co-determination in Germany, Volkswagen, a conspiracy to pollute the air, where the conspirators included the management of the company, the workers, one of the boss of whom took himself pay level at the executive level, and the state in which it resides, which was more concerned with maintaining employment than what people breathe. All of these things are cheap talk. The realities on the ground are that you see a lot of self-seeking behaviour, and it's a question of who's in the position. Executives are in a position, trade unions are in a position, workers when they're in this position. We have a fundamental problem, but it's not going to be solved by shuffling these pieces around, because everybody, it seems, when they're given the opportunity to put their hand in the pocket, does.
I would like to ask Jean, Yves Doss, I'm sorry. I know you wrote something about this, so I'd like to
Yes, and Yves Doss from Int'l. Just to add, one dimension we did not discuss, it's also the role of the people who select and promote CEOs and directors. There is a cottage industry around firms like Eagles and Korn Ferry and a few more. And really, the CEOs manage short-term interests in the company, but they also manage the next steps. Or more exactly, the next step is being managed for them by this small group of people, who essentially are very much part of this disconnect, or of CEO compensation and CEO performance versus real achievement in terms of managing the company, and create a high incentive for managing the stock price. So we also have to look at the outside world and say these people have their careers taken care of by these external kingmakers. So that's an important part of the equation.
I think, well, I don't want to take time. I will take one more comment and then we'll ask the panel if they want to say a few words.
I was just going to say, sort of in reaction to that, the concept of a stakeholder model is not one that pretends that everybody's not trying to grab the most for themselves. That's a fundamental Adam Smith, that's the butcher analogy. So indeed, that is what, of course, you expect people to do, which is why what we need is a societal acceptance of who should get what is fairness, what is justice, and not just throw justice and fairness out the window to the most powerful, because that is the system that we have been engaged in the United States, where the most powerful have been able to organize policy, organize regulation in their advantage, to their advantage, whether it be carried interest or whether it be the real estate developers who make $100 million and pay no tax, or Warren Buffett's point. I mean, so the question is not whether that kind of selfishness is going to happen. That's embedded in who we are. But that's where a society, and particularly the academics and the philosopher kings in the society, should be determining how that system should work, not just give in to the invisible hand.
Thank you, Lynn. One small point, okay.
To my honorable neighbor, we talked about income distribution as being an issue. Now we're looking at a place where income distribution in part is being determined, namely in the corporation. I agree exactly with what you're saying. There's a lot of cynicism, which is also what you're saying. Individuals are greedy. However, if we don't address these inequities at the micro level, we're going to have political implications and consequences. I think that's part of what we're about here today.
I would add one more point before I go to the panel, and that is one of the things that we hoped as a panel, that we would also talk about how can corporations enter the conversation that Lynn would like us to get into when they're suspect about their self-dealing, and that therefore how do conversation get into the story, or that for example, the ideas of dictator. So we didn't get to it, but I'd still like to raise it, okay? And give the panel, each one 2 minutes to say something
2 minutes,
that they
okay.
heard.
All right, I just wanted to respond to this question that's come up a couple times about what do we do about it? What do we do about especially this short-term nature of markets? And so, obviously, given we're called focusing capital in the long term, this is what we spend a lot of time thinking about. And so the things that I would suggest that we can change in a very practical way, one is governance. Governance is what we're talking about today, but governance is the foundation for long-term thinking. The next is alignment of incentives. So we've heard a lot about remuneration and other things, but I think if there are misaligned incentives, then we know things go awry. The third is engagement across the investment value chain between investors and companies, because that engagement, to some earlier points, is happening, and it may be happening in a productive way or an unproductive way, but that's extremely important. The fourth thing I would say is to focus on strategies that require long-term investments to pay off, and so those tend to be things around talent, because you obviously have to invest in talent. You have the J curve, you invest and you come out, so around talent, innovation, capital allocation, and risk management typically are things that require somebody to take a very long-term point of view. And then the last is the public policy as sort of a backdrop for all of this, which obviously is different in different countries, and to Lynn's point. So happy to talk about any of those more.
Brian?
Okay, so I guess, thank you for the opportunity. So Bill, hedge funds, I agree they are important. Indeed, when I was cutting my notes down, I was going to talk about them. And what the view is, in the 2000s, they became tremendously important. And they still are important. It just, people are talking more about the passives, so that's why I talked about that. It's not that hedge funds aren't important. With the intellectual development, the thing I'd say there, they were definitely important. But the thing is that I think that the world was getting ready in the 70s and the 80s because of dissatisfactions that were developing with how American corporations would be running that increased receptivity to those ideas. I mean, it's not just that you could come up with an idea, you needed an audience. So the fact that Harvard, they were a little slow, okay.
What's new?
And but yeah, so first point, I agree with you. Second point, I think it's a combination of things.
Actually, it's been shown, and there's an article on hits in Wall Street Journal, shareholder value, the term. It started in 1985. I think.
It
was big when Harvard hired Jensen.
Yes.
This made this credible in a way that had never been before.
There were items multitasking.
Well, the inequity discussion seems to be there. It seems to be partly louder, seems to be partly not so loud. And I think it's not the issue whether this is justified or not. It cannot simply be ignored. So companies should think about how to weigh in, and companies certainly have something to do about it and something to say about it, because as also was mentioned, every level of the hierarchy and the compensation rules that are applied are actually made by corporate decisions. So it's not only applying, of course, to the very top, to the decisions that the board makes with regard to top executive compensation. It also applies to all the other levels of the hierarchy, which also includes the very, very low level. And the question we have not dealt with today about the necessity of paying living wages for those at the very low shop floor level. So I think it's important to weigh into this discussion, because I fear that it could have, depending on some also social movements the potential to threaten overall the acceptance and the legitimacy of the existing system. Second comment, this was actually repeatedly brought up in some of the feedback from the audience. Yes, there is a selfish behavior and there is self-serving behavior, and perhaps it is something which is indeed a part also of being a human being, but this does not mean that we should simply accept it, right? So we should think about how can structures, processes, systems be improved or strengthened in a way that self-serving behavior becomes less likely or at least less impactful. And of course, we should also consider that we need a broader set of capabilities and values that we should analyze when we make appointment decisions, when we make selection decisions. So if we assess the performance of potential candidates for whatever job it is, not only at the very, very top level, but also on other hierarchical levels, I think it's important to have a broader view and not to fear, also to touch and to deal with subjects like ethics and values, which are actually important also in this context. And I think we need to deal more with this to really face the challenges lying ahead.
I will bring this panel to a close. I would like to make two observations or three. One is, if you feel like you want to engage this panel or you can influence our putting together some process and hopefully it will be a book that will come out. There will be a major section in this book that deals with these issues of corporate governance and the other dynamics that affect corporate governance. Okay, so if you have thoughts about it and you'd like to write to me, please do so. I probably will be involved in whatever volume comes out of this conference, mainly because David is too, it's very mercurial, but people like us, we know how to get these things done. So, so that's one thing. But it is a very important topic. I mean, I'm 85 years old, but I think it's just an incredible issue that we're allowed to rise. Okay. Secondly, we're all going to lunch together at some place. I don't know where we're going, but we're going. I'm going with somebody who knows where to go. And if you want to, sit together and talk about things, I think that would help us a lot. It is really a huge issue, in my opinion, because it's so difficult to deal with because companies don't have a legitimate role, are not viewed to be legitimate in influencing the process. And so that makes it difficult for companies to be part of this kind of process. It cannot just be outsiders who are thinking about it. Thank you very much. I hope you found it interesting, and hopefully we'll continue to have some conversation.